My name is Skip Sims, Senior Vice President of Ann Arbor Spark. I also am the Managing Member of the Michigan Angel Fund and member of the Michigan Angel Community. It Takes Money is a series of podcasts featuring angel investors and experts who offer insight on how to invest in startups. In these podcasts, we'll discuss the many aspects of angel investing and why they're choosing to invest in Michigan. Hi, today I'm delighted to have with me Stu Nelson. Stu is not a member of an angel group. What would we call you? The independent, for sure.
Independent, lone wolf.
By nature, lone wolf.
Yeah.
You have been very active angel investor, though.
Yes. Yeah.
And
Yep.
you invest in very early stage companies.
Yes. Where my money can make a difference.
There we go.
Yeah.
So, different perspective today, which is what we're trying to do with these podcasts, to expose you to different ways to go about investing in this asset class. And so, Stu, we're delighted that you carved out some time and talk with us and
help.
share with all this wisdom you've learned over
Well,
the years.
yeah, right. They call them scars.
I understand.
Yeah.
You're right. So, tell us about yourself. How in the world did you start doing investing like this?
Well, a good friend of mine, a number of years ago, 25 years ago or so, was the CEO of a very high-tech company that was in Ann Arbor, Michigan, and he and I spent a great deal of time together. And he actually went on to start a venture capital company, which I helped him do, sort of back behind the scenes type stuff for it. But he and I started investing in stocks together, high technology stocks, and we had some pretty good success because he is really a very knowledgeable person about software. And this is, like I said, 25 years or so ago, and we did very well. And the year 2000 came around, and we decided that it was time that we probably would want to take some of our winnings out of the stock market. And I thought, well, what am I going to do with it now? So I started putting that money into angel investments and in my own, creating my own, sort of private equity type, portfolio, one that's not marked to the market every day.
Right.
Luckily, because if my wife marked it to the market, I probably would have made one investment. But anyway, that's how I got started.
Yeah.
And I just have been, I'd gone back
since
to
2000. That's 18
that's
years.
when I started in the angel side of things.
Mm-hmm.
But I'd been since probably 1990, in the early 90s, I had gone back to school to get my master's in business, and I was a finance and accounting guy, and I love the financial side of businesses and still do. And so I've been attracted to it for a long time. I went out and I started two businesses myself while I was still flying. And one of them went out of business. One of them we sold to a bigger competitor. And I sort of got the bug there. These were not high-tech businesses. They were low-tech businesses. But I got the bug. And then I went on in early, I guess it was 1998 or so, I wrote a business plan for a company in Ann Arbor, and we went out, we raised $2.25 million, and we promptly went out of business when the dot-com crash came in 2002 or so, but we had a pretty good run. And, so I've just been, and I love all things high tech.
How many companies do you think you've invested in over the years?
Oh boy, 20, probably 25 maybe.
Mm-hmm.
And some, I don't put a whole lot of money in. I think my largest investment was, around $100K. Most of them have been around $25K or so, then knowing that it would take another $25K to get them
Yeah, but you've actually made,
make it.
because you also invest very early when they don't need a lot of capital.
Yes, right. Where it's
And so you've probably put in even less than that, maybe in one or two deals.
in several deals. Actually, I have as little as $10,000 in two other companies that actually are still going. You would know who they are too. Yeah, I just if you're the first in with $10,000, they'll take your money. I promise you.
Yeah, the entrepreneur sure will.
Yeah, of course they will.
So you do go earlier. So I want to talk about two things further that we've now discussed. One, how early stage you actually invest. A lot of angel investors, even. I've talked about on this podcast many times how the VCs have gone downstream. And,
yes, right.
And they're wanting that company to be
and the angels
already making money.
Are moving up
and
that
angels
way too.
have moved that way a bit and wanting to see some progress. You, on the other hand, will invest when it's more than an idea, but not a heck of a lot more than an idea.
Yeah, I really won't invest if they don't have a prototype, because I don't really have the technical background to try and figure out whether the science is going to work. So if they have a prototype that I can look at and see how it works, then I would get in at that stage.
All right, so I guess
pre-revenue.
So for that entrepreneur that might be watching this podcast, the suggestion is, look, you've got to bootstrap until you've got a product.
Yes.
Don't really go looking for people like yourself or myself or anything until you've at least got your product ready to start selling, marketing.
Right. I've been on the sort of the lecture circuit here for the last 2 or 3 years, and lecturing in various places to entrepreneurs about raising money. And I'm actually writing a book now with a U of M professor, a friend of mine, that I'm helping him in his class. Dave, at his Dave Brophy, and so
the Godfather.
Yeah, the Godfather. Yeah, right. But anyway, so he and I are, working on putting together this. It's called the Entrepreneur's Equity Roadmap, and what the roadmap is a way, to introduce founders into how to raise money, and to take their company from garage to greatness, and what they need to tell investors and what investors are looking for. And it's a big part of what I think is really important on the educational side of things for founders, is getting them to put their investor hat on for a while and think about it from what an investor would want.
Absolutely.
And then that's what the company that you need to build.
Yep.
And if your goal is to sell it to somebody else, then let's plan on that. So if you're planning on getting out of this business in 7 years or so, I don't recommend, trying to plan to get out of a business in 2 or 3 years or 4 or 5. It's not going to work. But 6 or 7 years, you certainly could design a business from garage to greatness where you had that exit.
When you finish that book, let me know. We certainly want to push that out for you.
Yeah, thank you. I would appreciate it. I'm working hard on it right
after
now.
18 years of doing this, I've got to ask, why do you still do this by yourself, independent? I mean, I know you'll call friends and use your network on your diligence, et cetera, but why do you like being the Lone Ranger, Lone Wolf?
Well, because one of the things, we just talked about it here in the panel discussion we just had, is that I like to make decisions rather quickly, and I don't like it to drag out, and I don't want it to be in a committee, and I try to be fair to the entrepreneurs, and so rather than having this dragged out maybe, I like to just give them a no right off yes or no.
That's one of the things we try and do is I'll tell the entrepreneur, look, one of the things we try and do for you, by the way, is tell you no as quick as possible.
And why, and
why.
And I think that's doing a big service. And then a lot of times then if I say no real early on, and then I go help them and I mentor them, like one of the last investments that I made was in a company called Sentinel. And it's a company that makes a gun safety device that's biometrically activated.
I've seen it.
And you put it on a gun and it falls off. But before I invested in that company, I mentored him for 3 years. I worked with him for 3 solid years. I'm still working with him.
Yep.
And he's been in business for 6 years. And it's now we're just finally starting to get some traction sales-wise. And so I like I said, I didn't tell him that I would invest or anything like that. I just volunteered to help
coached and
mentored and became a trusted advisor to him.
Yep.
And now he's like a son of mine, actually, And so
that's a very good point. I mean,
yeah.
you're giving back that's your way of giving back
to Michigan. That's my goal.
You helped this entrepreneur, and it took 3 years though before you actually wrote that.
Before I wrote a check. That's right, and
good lesson.
Yeah, no, it's a good lesson, and I feel that strongly about it. I've been fairly successful in life, and I love the state of Michigan. I've lived here the majority of my life, except for 15 years where I'm a California improved Michigander. and about out in the sunshine out there, but are now fires. So I want to give back to the state, and so I do that. I volunteer my time freely for people to.
Well, we sure appreciate it.
Yeah.
Well, and our economy appreciates it and needs people like yourself. Thank you very much.
Well, that's why I got to get that book out so we can,
can
see, because it's all, my book is based on my basic premise. If I have just another second or two, I'll tell you about it, is that, when you take money into your company, is that, people bring it in and they base the amount of money that they want to raise based on the needs of the business. But I suggest that they take that one step farther and they put it so that they base it on so that they raise enough money so that they can assure themselves that they're going to be able to have the valuation for the next round so that they can raise the next round also. Because you don't want to get stuck halfway between this round and the next round. You want to get to the point. Here's how I explain it to people, is that if I'm raise money, and I have 4 or 5 investors in an initial round. On the next round, if I go up to them and I say, Skip, look, I was able to, on paper here, we've doubled or tripled our value from the time you gave me your money. I've delivered on what I said I was going to deliver on, and I need to raise another $2 million. And you probably, because I doubled or tripled your money, you're going to go, well, yeah, hell yeah, Stu, of course I'll do it with you. But now let's take the same conversation and just twist it around a little bit and say, hey, Skip, I think I need to raise, some more money here, and I know this deal is going to be a little flat. And matter of fact, the valuation since you last gave me the money is probably a little less than what it was the last time. What are you going to say? And it's a pretty easy conversation.
It's hard, but it's easy.
I know, it's hard. So I'm saying, I'm sorry. It's fish or cut bait, and I'm cutting bait here.
Yeah.
But so what you need to build milestones that are valuation milestones, and those typically are generated by revenue.
Yeah.
So, and then you let the revenue, you figure out what revenue that you need to have and build your sales plans and your marketing plan, your product development plan, your hiring plan, all to feed into making sure that I have a $2 million annual run rate of my revenue 18 months from now, so that I can go to the venture capital folks and see if they would put some money into it.
And along the way,
keep
you as the investor aware
Yes.
of all of those roadblocks you keep running into, the bumps you keep hitting, and seeking your advice, seeking your counsel.
Yeah, totally. And, and I think it is a real commonality that we have of our younger generation is they don't want to get on the phone. Everything has to be text messaging and emails and stuff. But sitting down with your investors and talking to them quarterly or something, it's like sitting down with we used to have to sit down with our banker, You always should know the banker that you're doing. You should own stock in the bank you're doing business with. But that's a relationship side of things, and I think that our young entrepreneurs just don't quite understand that. They don't get that. Maybe it's because they're not mature enough or what, but they don't understand that you really owe it to these people.
Yeah.
And an executive summary is a promise. And if you put your financials on the executive summary, you've promised that that's what you're going to do.
Mm-hmm.
And if you don't, then you're going back to your investors with your hat in your hand. And I think it's very difficult. I've done it.
That's harder than raising the money the first time.
I've done it. Yeah. Oh
Yeah.
You kidding? I've been there, done that. And you don't want to go back to your investors, with your hat in your hand. So no bridge rounds. So let's get all that stuff. The bridge round's a 4-letter word. So anyway.
Hadn't heard that one before.
Yeah, no, it is. I think it means that you didn't plan right.
Stu, thank you so much.
Yeah, anyway.
Appreciate your time.
Skip, always.
Thank you.
It's fun.
Thank you for taking time to listen to It Takes Money. For more of our podcasts, visit AnnArborUSA.org/podcasts or MichiganAngels.org. Thanks to the Ralph C. Wilson Jr. Foundation for making these podcasts possible. And let me leave you with this from John D. Rockefeller. It is a mistake to assume that the possession of money in great abundance brings happiness. Pleasure comes not from the possession of money, but from the ability to do things for others, which brings satisfaction.